It is when the consumers say, hey, you are giving me X return. With a similar kind of a risk profile, somebody else can give me X plus delta. Why you can't provide for it? So that kind of a pressure also has to come in.
From the insurance sector, you know what to expect from him. I could see that the body language of all the people who were there in the panel, the change, voice also raised the moment he walked in and talking about how they are ready to serve the customers and everything. So let's hear the regulator, because still there is no clarity about the GST cut. And in fact, whatever little for a couple of minutes you heard also, they're looking for some excuse or other. Let us feel the pulse. Let us see the pitch. How do we pass it on? Customer is the king, all good, but balance sheet also there. So what's your expectation as a regulator? How should they react?
Thank you, Tamal. First of all, my thanks to the entire Business Standard team for this invite and an occasion to interact with the financial sector captains and stakeholders here. As a regulator, this being my first appearance, I would like to assure that I have an open mind. Based on data, based on analysis, based on the perspective which I hear, then I reach a conclusion. But nothing is done without extensive consultation, generating discussion, building consensus, because I draw my strength from what the Parliament has mandated. Protect policyholders' interest, other side of the coin, regulate, promote, and orderly development of the industry. Orderly development is what is important, and that requires building consensus around any reform which is needed. Now, coming to Tamal's question, which is around the GST part, where we are coming in, let me share my perspective. And also being associated with some of that conversation before the present job which I have, what the government has signaled here, as far as this sector is concerned, look at the tax rate on insurance products, 0. Food items have 0, unprocessed, processed as 5%. What is the signal which I draw from here? As a matter of fiscal policy, government is equating or as placing, not equating, putting it as important as something which is essential for life. Food, the most basic of the entire thing. And then is saying that fiscal policy, maximum possible support will be provided. Now, this is a huge opportunity for the sector, that how do we bring focus on the consumers. And as one of the comments came in here, Anup perhaps mentioned that point, and Mahesh mentioned the point that we are a high-cost sector. Are we content with that? Content with serving top 10% of our population? No. We should be rather following it up, CK Prahlad, bottom of the pyramid. That is what the most of the growth will come in, 140 crore people. Now, that is a moment where government has said maximum possible support. Now, do what you can do. And there the question from the regulator comes in, that where are the question of economizing our own cost? Go from a high cost to a moderate cost, good quality services, and be very clear that CK Prahlad never talked about a poor quality product or services. Good quality, but a very efficient sector. That is where we have to move in. And I find there are several pieces in this entire sector where there are possibilities of economizing on the cost. And just I cite one data point. Commissions, which form a very significant part. Or let me talk about first the overall expenses. Life is about 20% of the risk pool is cost of procuring the risk pool and managing that risk pool. And that too, a significant part of that risk pool is not really the risk pool, it has a lot of savings also. Think of any financial sector where the cost of managing a savings and risk pool is 20%. How is going to grow that sector? Non-life, 30%. I'll cite one more data point. Commissions to corporate agents, and that includes even the banks. They are also work as the corporate agents. The most efficient, I'm not talking about LIC here. LIC is not a player or is not on the corporate agent. They don't use that channel. The largest among non-LIC player they pay 4% of their premium towards the corporate agency, get half of their business through that channel. The second largest also gets roughly about half of its business through that channel, pays 17%. Now, look at this wide variation. Is there any scope for economization? Yes. So we have to move toward that direction. Who has to do that is a matter of discussion, etc. There are several points coming up. So I see, Mr. Tamal, that aspect. This is a golden opportunity for us to just grab this opportunity, make the products much more affordable, much more efficient, much more attractive to the people. And another comment, we can bring horse to the water. Here, consumers are not horses, but nevertheless, unless they see value, the sector will not grow. So we have to create value and make that happen.
Absolutely, absolutely. Very clear message from the regulator. But now, just from the other side of the table, on behalf of industry, I have a question to you. Now, if you look at the insurance sectors over the past 5 years, first the tax on ULIP it came, then the COVID, which is nothing to do with regulations, but it's an event nobody can ignore. Then you have this, again, tax above 5 lakh premium and all. Then you have that expense ratio tweaking and all. And then working on the surrender charges, and then the GST. Now, industry feels in private, they said that, look, there is so many things, it's very, they suffer from a sort of instability. They're looking for a stable few years to put their acts together. So, as a regulator, sir, can you tell us that there'll be more such thing? I'm not calling it shocks, but certain things which will actually, every time they go back to the drawing board and redraw their plan, or they can expect a sort of stable few years during your regime.
Again, correction. There's nobody's regime here. It's always a...
During your tenure, okay? During your tenure. Sorry, I correct myself.
Relay effort. One gets a baton, does one bit, passes on the baton. And that is how it happens. Private sector, public sector, it happens in all those sectors. But coming to our aspect, insurance sector, and if I can talk about a little more detail, health insurance is an unstable equilibrium at this point of time. Life side is a low efficiency equilibrium happening, but competition, other channels which manages savings pool of Indians, they are giving a tough competition to life insurance companies which provide insurance cover and also the savings management aspect which were to happen. So this aspect that is status quo is the answer to move forward. If you want to live with a low-level equilibrium or an unstable equilibrium, status quo is the answer. But does it require shocks? No. It requires an orderly transition to a better tomorrow. That is where it has to come in. And where I find it is starting from, say, the shareholders, and this aspect came in. Are we the best user of capital? There's a lot of scope to improve upon that capital. Some of it is arising out of what the prescription regulator might have done. That itself is one area to improve upon, what allocation for various risk events will have to be provided for. Similar manner, distribution, if I were to mention it, that the biggest piece which requires attention in this sector is the distribution piece, the kind of a distribution reforms which are needed. And that doesn't mean, I talked about commission, but ultimately there are various segments from an agent to a corporate entity. How does the economics work for each of those entities? Because the one factor which requires a conversation is needed based on data, not based on impressions. Improve the economics of the sector for each of the constituents of the sector. That is what it would help in moving in that forward. So no shocks, but status quo is also not an answer. A orderly transition to a better tomorrow is the answer.
Absolutely. I think the industry has got the answer. Early this year in one of the conferences, Finance Minister spoke in London that India is on track to become the 6th largest insurance market by 2032, growing at a compounded annual growth rate CAGR of 7.3% between 2024 and 2028, highest among the G20 nations. And one of the things that I think government has been banking on is the change in the act, 100% FDI. So it's a couple of things related to that. If you can throw us some light, sir, what's happening to that Insurance Act? Now 100% FDI will take care of the capital part, but the distribution which you just highlighted, it's a different ball game altogether. So capital is taken care of, but how do we take care of distribution? That's point number one. And point two, it also spoke about composite license. Now globally, I think Singapore is probably the only market where the composite license worked, nowhere else it worked and all. Because there are two different products. One is for 30, 25 years, one is for 1 year. So how do you manage the treasury? It's a very difficult task. So is this the way to go forward? Is this one umbrella organizations and which will have two wings, which is one life and one non-life? Is this the way to go? And how does it work, entire thing?
First, this aspect of announcement of opening up the sector to 100%. I'm sure that in those changes, legislative changes will come. At due point of time, I will not be in a position to comment about the exact timeline, but that alone will not be in a position to take care of the capital requirement. Just given a perspective, my data, insurance industry today, the own capital is of the order of about 3.5 lakh crore, not 2.5 lakh crore, both life and non-life put together. FDI is welcome. All those players who have come in are welcome. They have provided a contribution. But still, the significant part is the domestic capital. Out of 3.5 lakh crore, total FDI which has come to the sector is about 90,000 crore. And all is not in the balance sheet of the insurance company. That's have gone to pay the previous shareholders, etc. So domestic capital is equally important. Now coming to those aspects that what will...
how do you take up the distribution? Capital is there.
The distribution...
And the composite one.
The distribution and the composite aspect. First, look at the person who is interacting with the policy holder. Is that person is getting enough income out of it? Today, an agent getting 10,000, 12,000 rupees a month is not one can sustain a family. Is an agent is in a position to get 30, 40,000, meaning more volume, lesser income. So when one can be a lesser volume and more income, more margin kind of a thing. Similar manner, sharing the resources. Say resources not in terms of the money, instead of being a uni-product. It can be a multiple product when an agent or a corporate entity were to reach it out or a broker reaches it out that provide for multiple products. Some experience have been good, some have not been good. For corporate agents, open architecture was facilitated in 2022. Commission rates have not gone down thereafter. Now, that also has to look at where the economics has not worked out. So we have to look at that aspect. When one is talking about getting to bottom of the pyramid, or to put it from top 10% to the top 50% of the population, leave alone the bottom two, we will not leave alone in that sense. For them, there is a different product is needed, different services are needed. Even to get somebody who is earning roughly about per capita income of 2.5 lakh rupees. When that person is being touched upon, the affordability, the conversation has to get into the affordability and the reach. So distribution reforms, to my mind, objectives are two. How do I expand reach? Today, the capital markets, here, we are sitting in Mumbai, which is the market here. Most of the growth is coming from tier 2, tier 3 cities. Insurance sector, getting into tier 2, tier 3, and thereafter smaller towns, and thereafter getting into the rural areas. Affordability has not come in our conversation. And that is a value proposition for the people is important here. So these are the objectives, but we do expect to generate discussion papers before we get into a formal consultation and thereafter getting into that what needs to be done for the sector.
Yeah, Mr. Seth, you're just deviating from insurance sector per se, but something very related thing. Yesterday, there was a banking day, so we were discussing about how the bank's credit growth, where the money is going, and the bank can't afford to be in the infrastructure sector because of the asset liability mismatches. They have their average period of 1.5 year deposits, and infrastructure is much longer term and all. So insurance segment is one where the long-term money is there. But going by the insurance law, the rating must be either AAA or AA for infra projects to get any insurance money. It's very difficult. I mean, we can't count on hands that how many there with AA and AAA. So as a net result, actually the long-term money is not flowing into insurance money, not flowing into infrastructure, which we need because to give the economy a real push, all of us know that there has to be focus on infrastructure. So is there any way we can change the norm or to just bringing it down the rating to get insurance money there, or some kind of say credit enhancement facility, credit default swaps? I don't want to get into all the technicalities, but there are ways of handling it. Is it on your table?
Tamil has been, is being nice to me, that not getting to technicalities from his opinion pieces, he gets into fair amount of technicalities and explain it in a very easy to understand for the entire readers of Business Standard and beyond. But coming to this specific topic, out of a total AUM of asset which is being managed about 75 lakh crore, 7.5 lakh, 10% is infrastructure sector. Yes, it's a small one. But is the law, the regulations in the way? No. Regulations do allow for not more than, or at least 50% in the government securities, rest can be in other corporate bonds, and even in non-fixed income securities also can be there. And then whereas the general category got 15%, but where we are, just about 2%. So here is a question of both push and pull factors have to work in. Today, insurance industry is looking for a good quality paper. You may ask that everybody say AAA, is that AAA is only available there? Fair amount of work is needed in terms of the pull factor, and wherein as an insurance regulator, my job to work very closely with SEBI chief, with RBI governor, that how do we create conditions for more mature, more deeper bond market in the country. And now that is a piece which is needed, and there the role of the credit rating agencies also becomes very important. Like today, if a paper is rated A and there's a deterioration in the quality, how quickly the investor gets to know about it? Where is the secondary market to take an exit at the right point of time? So that is a more of a pull factor. But the push factor, also the insurance industry, a conversation is needed. What kind of a return, what kind of a push will get generated? It's not by regulations can say, hey, you can invest up to a particular percentage in a product. It is when the consumers say, hey, you are giving me X return. With a similar kind of a risk profile, somebody else can give me X plus delta. Why you can't provide for it? So that kind of a pressure also has to come in. If any guardrails are needed in terms of getting an area which is relatively, I won't call it less safe. There are various, because it's a continuum one is talking about. We are ready to look at those guardrails, like getting into an unlisted equity through AIFs, InvITs. Some of the insurance companies have started. Some are reluctant to get into those areas. What kind of a guardrails are needed? What kind of a track record of those managers are needed? That conversation is needed to get into an area which can provide, given a risk profile, good returns, and still be clear that shareholders will not be asked for any default to happen.
Thank you, sir. In India, I mean, past few years and now, the moment you talk about insurance, in your mind is come just two words, Bima Trinity. Bima Trinity, all about Bima Trinity and all. So I don't want to again talk the same, repeat the same thing, but only one aspect of that Bima Sugam, which is a sort of UTI movement for the insurance segment. I'll call it a UPI movement and all. And now, it's been notified. You also got involved in that website and all sorts of things, Bima Sugam and all. Website you launched, etc. So can you give us a sort of progress report only on that aspect of Bima Sugam?
The big piece next to distribution reforms, if I have to cite one, or the mentioned one, would be the DPI, Digital Public Infrastructure for Insurance. And we have not really made even a beginning on that, or we are just about making a beginning. Look at banking sector. The way banks could expand their reach, Jan Dhan accounts, increasing the balance in those accounts, providing the services, thereafter the UPI moment coming up, capital markets. In spite of COVID, they could expand very significantly because they had adopted, they were ready for DPI. DPI in insurance, and perhaps Mahesh talked about insurance history of people. What is just like akin to a credit rating, or perhaps Tarun mentioned about that aspect. So that next piece is digital public infrastructure for insurance sector, wherein in the regulator, we see Bima Sugam as an entity which is consumer facing. And at the back end are the insurance companies. That kind of an efficient platform to be ready. They have made a beginning as the products and their services should be coming in the market in the next few quarters. Second piece I see it there is a market infrastructure of market infrastructure entity, which is a IIB, Insurance Information Bureau. Perhaps owned by IRDAI or in the public sector for sure, as a custodian of data, which provides that information to insurance companies. So there the consumers are insurance companies. At the back end is the insurer. At the back end is the IRDAI. So these two pieces, one, a market-facing entity, which is the Bima Sugam. Another one is a provider-facing entity, which is infrastructure agency, insurance infrastructure agency, which is IIB. And that kind of a combination is providing for using technology and the efficient way of managing the sector in an efficient manner.
Just some time back, I spoke about finance minister in London talking about the insurance growth and all. Prime Minister has been spoken about by 2047. It's an insurance for all, right? Now, globally, if you see that when you talk about the insurance penetration, the yardstick or the benchmark is this, measured as a cost of premium to GDP. But India is a very different story. I mean, here, how many people are covered? That's what is important, not at the end and all. So again, then the intermediation comes. Do you agree that's the way it should be? It's not a premium to GDP, but more and more coverage in terms of population coverage.
Now, I'm glad that you asked that question. For an investor, or how the globally this industry looks at it, they look at penetration, premium to GDP, or density, premium per capita. We are a 2.5 lakh per capita, about $2,800, $3,000 per capita country, 140 crore people. While those parameters are important when one is talking about to shareholders, or especially the foreign shareholders. But for the sector's growth and serving the purpose, what is those parameters of people covered, life covered, some insured cover, when it comes to the non-health, non-life, those are the questions which are important. Premium per unit of risk covered as proportion to per capita income. These are the parameters. We have not even started tracking those ones. This is the conversation we would like to, from the regulator, we would like to start conversation around it, because these are the parameters which are equally important or far more important for our country, exactly, where the current level of reach is rather limited.
Exactly. So one more thing is this, apart from the business, penetration, capital and all, IRDAI also started that the lot of things to take care of the risk. The risk-based capital norms have come, and compliance with the international reporting, financial standards, transition to risk-based supervision are underway. Everybody is waiting for that. Can you just give us a sort of update on that?
In the past about 4 years, there has been a good conversation. I'm saying past 4 years, post-COVID, there has been a good conversation between the industry and the regulator. Various gap analysis, where do we stand, what it would take to reach there, that exercise has been done. In terms of sequencing, you talked about 3 pieces. Moving towards IFRS or Ind AS, let's talk about our own standards, Ind AS. In terms of sequencing, I'll mention that as the first one. And that's a larger piece we have to do it. And I see today the preparedness is move to that one in about a year's time. May not be 100%, but bring significant pieces around that and then provide a glide path to others who may require time to reach there, because that may lead to some amount of, everybody will not be ready. Bigger companies would be ready, smaller companies will require some time. So that's the first piece to come in on the move over to Ind AS. You asked about composite license. This is one of the enabler, meaning this is a prerequisite. Without this being there, the transparency on the balance sheet and P&L account, one can't be getting into a composite account. One can't be creating those compartments, will not be there.
Absolutely.
And the second piece will flow from there, the risk-based capital. Now, the risk-based capital is, again, where is the efficient use of the shareholders' capital? Rather than saying that in regulator we feel this is a risk, so much percentage has to be allocated. No, it has to be much more efficient piece. So second piece arises out of risk-based capital. But risk-based capital will help few companies, will be challenging for others. So there we have to think it through, that how do we provide for that kind of a glide path or give them a longer period to reach there, but the journey has to begin. As long as we are taking a step and we are sure of our path, we will end up there. Third piece, you talked about risk-based supervision framework. There will I'll say that one piece where we have to spend a lot more time, and I would like to have that conversation with the sector, is getting into the corporate governance. Risk-based supervision framework requires a much more solid, robust corporate governance. And that is a conversation with the insurance industry. Not that there is any major issue coming up over there, but the moment we talk about a framework, that is a prerequisite is happening, and then a structured discussion around the corporate governance is needed.
Thank you. A lot of clarity. Actually have many more questions, but I will just only ask one, and then after that, one or couple of questions, all that industry from there we can ask. So one just from my side, last question is this now. If I'm not mistaken, there are now 57 insurance companies in India, 24 life insurance, 33 non-life, and 1 national reinsurer. Now, if you talk about the kind of penetration by Indian yardstick, not the global benchmark that we discussed, everywhere it has to go, certainly we need many, many more. There's no question that many more insurance companies and all. Now, my question to you is this, do you see a merit we go the banking way? What I mean banking way is this, there's universal bank, and then a decade back, Reserve Bank of India started with, look, everybody does not have to be insurance in universal bank. It could be small finance bank, payments bank. Payments bank not exactly succeeded, but small finance banks are there, and then new are coming, and some of them are getting upgraded to universal bank, etc. Is it possible to replicate this kind of experiment in insurance segment also? You have a separate capital requirement, have a smaller insurance companies for region specific, and then later they can upgrade them. It will help penetration. After that, a couple of questions we're running.
Certainly, more companies are needed for sure. More customized companies are needed for sure. So national level, multi-line, national level, monoline, depending upon the business model they want to do, or a geographical concentration if somebody wants to address there. So as a regulator, we are ready to provide for a differentiated level of business model. But you talked about a smaller capital requirement.
Yes.
Now, capital requirement, that is a tricky part. Now, here the limit is minimum 100 crore.
This is what in banks they have done, 500 crore for universal, 100 crore for, or 200 crore.
But this is only an entry level. Talk about a bank which is operating at 500 level. The moment its business grows, it gets an asset-based CRAR kicks in. Today, out of 77 or 73 companies which you mentioned it, just about 10, 12 have their capital deployed of less than 1,000 crore. Everybody is above that. So even the beginning one, more capital is required. 100 is only an entry requirement coming up. So this part, the younger companies are finding it difficult to differentiate themselves vis-a-vis others. Now, there lies the challenge that how do we create conditions, and there the distribution reforms and more efficient of the capital will help them also to compete with more established players. That is a piece which is needed.